Okay, let's jump right into this. Today, we're acting as financial detectives, dissecting an absolute bloodbath of a market event, the KOSPI plunging a massive 8.95%. It all kicked off with an earnings warning from SK Hynix, but man, did it escalate fast. We're talking serious structural panic about a broader AI demand slowdown. The speed of the sell-off was just relentless. But here's the real kicker. The structural triggers that turned a simple earnings miss into a historic systemic crash, they're hiding right in plain sight. And if you're holding tech equities today, you absolutely need to understand this. The sheer velocity of this breakdown was, frankly, staggering. The KOSP didn't just dip, it completely fell through the psychological 7,000 level, eventually closing at 6,806. Now, you know as well as I do that for both retail and institutional investors, that 7,000 mark is a massive line in the sand. Crashing through it meant months, literally months of slow, agonizing, hard-fought portfolio gains vanished in minutes. When a market moves this fast, it throws fundamentals right out the window. It becomes about pure, unadulterated risk reduction across the board. And the damage wasn't just contained to a few overhyped assets. It was totally systemic. We're talking a brutal sea of red where 4 out of every 5 stocks on the exchange crashed, 716 out of 945 listed equities closed lower. This kind of breadth, it tells us investors weren't just selectively trimming their portfolios. No, they were liquidating everything they could get their hands on. But to figure out why the entire market suffered such a synchronized meltdown, we have to isolate the exact spark that lit the match. So what was the catalyst? It was an earnings warning from memory giant SK Hynix. A major brokerage forecast their Q2 revenue at 80.9 trillion won. Now, in a vacuum, hey, that's massive growth, right? But the problem is it missed the broader market consensus of 84.57 trillion won by 4.3%. And in an AI-driven market that's priced for absolute, zero room for error perfection, even a whisper of a slowdown is fatal. A slight revenue miss like this acts as an immediate trigger for investors to completely reprice their expectations. But it gets worse when you look at the profit side, which, let's be real, is what trading desks actually care about. That same report forecasted operating profit at 60.4 trillion won. That is a full 8% miss from the 65 trillion won consensus. This wasn't just a minor top-line hiccup, it signaled a fundamental shift in expected profitability. Operating margins are literally the lifeblood of tech valuations, so an 8% miss, that instantly sent shockwaves through institutional desks all over the globe. The structural root of this whole mess is hidden right inside high-bandwidth memory, or HBM chips. Simply put, these are the ultra-fast memory components that act as both the crucial bottleneck and the main power source for the entire global AI revolution. SK Hynix has basically bet the house on the revenue from these specific chips. But, and this is a huge but, there's a massive catch tied to how they actually sell these things, and it's a catch the market suddenly woke up to. The core issue boils down to 3 to 5 year fixed contracts. Normally, long-term agreements are great. They give companies solid, predictable financial stability. But during a massive AI supercycle, this heavy reliance on fixed contracts means SK Hynix is structurally choked off from average price growth. They are basically locked out of the explosive, real-time pricing of the current market. So that estimate cut we just talked about, it directly reflects the harsh reality of these unmoving contracts dragging down potential profits in a booming sector. The institutional reaction to this realization was practically algorithmic in its speed and super violent in its scale. Foreign investors, who, remember, carry massive gravitational weight in the Korean market, they didn't hesitate. They pulled a staggering 1.42 trillion won directly out of SK Hynix in just a single day. To put that into perspective, that one move accounted for over 82% of all foreign net selling on the entire exchange. When foreign capital flees at that kind of scale, local markets shatter. Naturally, this aggressive capital flight sent the stock into an absolute freefall. SK Hynix shares completely plummeted, wiping out 15.37% of their value in one trading session. For a mega-cap tech giant that essentially anchors a national index, an intraday drop of that magnitude is a historic wealth destruction event. It completely upends the balance of the market. But wait, if we dig a little deeper into the underlying capital flow, we see a much more precise, calculated strategy at play. See, foreign capital absolutely dumped the chipmaker, yes. But they simultaneously turned around and deployed that capital right back into its holding companies. They injected 111.6 billion won into SK Square and another 17.2 billion into SK Inc. So they weren't fleeing the corporate group in blind panic. Actually, they were actively managing their risk, seeking out the safer valuations and dividend protections of holding companies while stepping away from the direct, messy volatility of the memory chip business. The problem is, market fear is incredibly contagious. The panic over a potential AI slowdown didn't just stop at the gates of SK Hynix. It spread like wildfire, rapidly infecting Samsung Electronics too. Even with Samsung's massive global scale, incredibly diversified facilities, and robust digital ecosystems, they just couldn't defy the gravity of the sell-off. The spark jumped from one company straight to its biggest rival, triggering a total, indiscriminate sector contagion that spared absolutely no one. Samsung shares ended up crashing 10.7%. And this is crucial because Samsung and SK Hynix are essentially the twin engines of the Korean market. They carry massive index weight. When both of these giants stall out at the exact same time, the math practically guarantees a broader collapse. Their combined drop dragged the entire electronics sector down a devastating 12.22%. The floor completely fell out of the tech space, forcibly dragging down passive index funds and broad portfolios right along with it. As the index plunged, the machines took over. Automated trading systems kicked in, unloading 1.89 trillion won in ruthless, non-arbitrage program selling. In plain English, this is software that blindly dumps a massive basket of stocks all at once based on downward trends rather than humans looking for specific price discrepancies. This wasn't about human emotion or panic anymore. This was automated risk management software executing pre-planned liquidation sequences at light speed, completely indifferent to whether these companies were actually healthy or not. This intense pressure built into a cascading structural failure so fast it would make your head spin. After opening down just slightly at 0.85%, program selling accelerated so rapidly that a sidecar was triggered at 10:34 a.m. If you're not familiar, a sidecar is an emergency mechanism designed to temporarily pause these automated orders and cool the market down. But it wasn't enough. By 1:28 p.m., the panic overwhelmed the system entirely, triggering a full circuit breaker and forcibly halting all trading on the exchange to prevent a total freefall. To really grasp why the market fell so incredibly fast and tripped those emergency halts, we need to talk about the hidden structural risks of leveraged ETFs. These are funds that use complex derivatives to double or triple the daily returns of an index. They're great on the way up, but the critical, built-in flaw during a crash is that these funds mechanically force buying or selling as the underlying stocks move. They are completely blind to the actual fundamentals or true value of the companies they hold. Because of this super rigid structure, trust accounts managing these leveraged ETFs were mechanically forced to liquidate. As the market fell, the mathematical formulas governing the funds demanded immediate selling, period. This resulted in a staggering 1.64 trillion won being blindly dumped right into an already plunging market. It creates this terrifying, self-fulfilling, vicious cycle. The market drops, the funds are forced to sell, the selling drops the market even further, and the cycle accelerates the crash way beyond normal levels. And to make matters worse, this forced institutional selling was incredibly concentrated. It was like a targeted missile strike. Over 92% of that blind trust account liquidation hammered just two specific stocks, SK Hynix and Samsung Electronics. Because of their sheer size in the indices, they absorbed almost all the forced selling. This massive volume far exceeded their standard market weight, artificially driving their individual stock prices down way further than what regular sentiment or that initial earnings warning would have ever justified. But you know the golden rule of the market. For every seller, there's eventually a buyer. While institutional capital and algorithms were rapidly cutting exposure and fleeing for the hills, retail day traders rushed right in. Seeing historically low prices for premier blue-chip tech, individual investors stepped up with incredible, almost defiant conviction. They absorbed the massive institutional sell-off, deploying a staggering 3.89 trillion won in net purchases. They were essentially attempting to single-handedly catch the falling market. However, the extreme, unmitigated portfolio risk these retail investors took on is honestly alarming. An astonishing 99.98% of that 3.89 trillion won went straight into catching these specific falling knives of SK Hynix and Samsung Electronics. Let that sink in. Practically zero capital went toward diversifying across the rest of the broader market. Retail traders basically bet their entire war chest on just two volatile tech giants recovering instantly, throwing standard portfolio diversification completely out the window in the middle of a historic crash. So this leaves us with a stark, lingering question for this explainer. Are these bold retail investors brilliantly buying the tech dip of the decade? Or are they going to be left completely exposed, holding the bag as global AI demand potentially normalizes?
The underlying data shows a market currently fractured by extreme capital concentration and deep structural vulnerabilities. Only time will tell who is actually standing on the right side of this historic trait. What do you think? Let that sink in as you review your own portfolios.